Good day, everyone. This is our continuation of our discussions involving financial statement and cash flow analysis. But in fact, financial statements on the plural sense. So make sure to watch our first part or portion of this series, just two parts of them, discussing about financial statements and cash flow analysis. And now we will proceed to cash flow analysis. We have to take note, as mentioned, that although financial managers are interested to look into the information contained on accrual-based financial statements, meaning to say our financial statements from financial accounting and reporting processes, especially our outputs, again, the financial statements from statement of financial position, formerly known as balance sheet, down to notes to financial statements. However, as financial managers, the primary focus would be on the cash flows. So we've said this one that as financial managers, the focus would be on how to increase the cash flows on top of maximization of shareholders' wealth. Without adequate cash to pay obligations on time, to fund operations and growth, and to compensate owners, the firm will fail. So in financial management, whether we like it or not, this is all about adequacy of cash to pay our commitments, financial obligations on time, whether that's short term or long term, with respect to liquidity and solvency accordingly or respectively, then whatever needs, whether that's operational or transactional, whether that is precautionary, so just to protect ourselves and the company in cases of certain casualties or calamities, talking about insurance, or speculative purposes like talking about investment opportunities. So those things, and also to provide something to the owners in the form of dividends, which are to be paid normally in the short term. So these are just the things that we need to look into about cash flows. If we do not actually hit these, then the firm will fail. So we'll look now into this particular diagram, which will look into the firm's cash flows. So the reservoir of liquidity containing both cash and marketable securities is impacted by the three changes. Our acronym would be OIF, operating, investing, or investment here, but normally investing, and financing flows. So if you look into cash and marketable securities, by the way, I've made a word of warning from the first part or portion of this video that if we say marketable securities, we're talking about the cash equivalents, which are the short-term investments that are convertible to cash, easy cash within 90 days or less, as banking practice or part of banking practice, which is 90 days. Because during such number of days, we can say that there is insignificant or immaterial or not substantial changes of values of these particular financial assets, especially again, these so-called cash equivalents, because we have also marketable securities or short-term investments, which are beyond 90 days or 3 months, but in a year or less. That's why short-term, because if beyond 1 year, that's long-term. Anyway, going back, so we have the three flows or the activities: operating, investing, or investment and financing, but I'll be using investing. So operating, we talk about those expenses, those payments, if not necessarily expenses, because expenses are not, of course, synonymous to expenditures, just to review. So expenditures are payments or disbursements, but expenses are gross outflows of economic benefits. So they're not synonymous per se. And then these are our sources. So we have, for example, from our operations of business, whether that's sales, whether that's administrative functions or production. So those activities that we are looking into, including also our cash inflows coming from sales and all other sources of income of the company. So these are the things that we have to look into about operating. Next is for investing activities. We are now on the non-current assets or long-term assets acquisition and sales. So that's why we have here the fixed assets like property, plant, and equipment, intangible assets, and other non-current assets and the likes. Now, for investing, we also include our investments in other businesses. Example, we have investment in associate for 20% to 50% shareholdings. If beyond 50%, 51% minimum, that's already subsidiary. Formerly associate. Second is, of course, I repeat, these are on the associate and subsidiary with significant influence and control respectively. So these investments, together with other investments like investment in branches, joint ventures, and etc., should also be part of investing activities, in as much as we are going to acquire businesses, but it's possible that we also sell, or we are going to have to sell our shareholdings of different businesses. So that's why that's still part of investing. And then moving on, we also have financing. If operating would focus into current assets and current liabilities, meaning changes in working capital, and investing would focus into changes in non-current assets or long-term assets, financing flows would focus into our non-current liabilities and our equity changes. So that's why we can see here for borrowing and repayment, we have debt long-term. Why is it there's short-term? It's because this is the exception to the rule. We've said that for current liabilities, we have to include them in operating flows. However, if these liabilities are non-trade, so not part of the buying and selling activities of the organization, because these liabilities, we are on the buying aspect with respect to accounts payable and notes payable in relation to the purchases of goods or raw materials and or including supplies, including indirect materials needed for the operations of the business. Now, if we talk about notes payable coming from borrowings from the bank, if that's short-term or long-term, that's part of financing flows. So borrowing of the money, that's an inflow. Repayment would be an outflow. And then allow me to go back with the purchase, that's an outflow, while sale is an inflow. For the equity, for the stocks, if we issue shares, so we sell shares, then that's an inflow. But if we buy back the shares to become treasury shares, it's a review in corporation accounting, that's going to be an outflow under financing activities. And then payment of cash dividends, that's clearly outflow. So these are the three activities as classified. Now, these items are actually found on the T account or general ledger account of cash and cash equivalents. We are just subdividing them so that we can properly analyze the components of our cash flows or cash and cash equivalents. Moving on. So after cash flow and the firm's cash flows, we have the free cash flow concept. So knowing that for the operating cash flow, EBIT, earnings before taxes and interest, of course, that's prior, minus taxes. So we are going to deduct the taxes and we add back the depreciation. So this is our shortcut for our operating cash flow. So this is just a formula in financial management. But then just to say that we want earnings to be net of taxes and then depreciation is to be added back, it's because depreciation is a non-cash expense. So therefore, there is no outflow to begin with, and it's deducted to get EBIT. That's why it should be added back. All right. Well, taxes are clearly outflow, so we are going to deduct, and then interest will remain. So it's okay. And then moving forward, there's also another formula. FCF or free cash flow is another concept, as said, and this is our formula to get it. Operating cash flow minus change or changes in gross fixed assets. So we talk about our acquisitions of the fixed assets and their respective balances. So we talk about like comparative years and we get the change of the two. Let's say 2021 versus 2020. and then minus change in current assets, plus change in accounts payable, and change in accrued liabilities. So basically, we are going to deduct changes of all assets, and then we are going to add back changes though of current liabilities because we are looking into accounts payable and accrued liabilities. All right, moving on. So we now look into the inflows and outflows of cash. So we talk about plus and minus. Now, for our changes in working capital, especially for using indirect method in preparing statement of cash flows, if you have watched our discussions involving statement of cash flows, there are basically two types under operating activities section. We can prepare either direct method or indirect method. Direct method is simply looking into our changes in the T account and subdividing them into three components. And then for operating activities, all items in relation to operations, current assets and current liabilities. For indirect, we start with the net income and we are going to add back whatever items that would actually decrease our net income. And then on another hand, we would also deduct if ever anything would increase our net income and vice versa. So example, let's say we have to take note that assets and equities, in which under equities, profits are components, are indirect proportion or relationship. So if ever assets would decrease, this means that our equity slash income would also decrease. Therefore, we have to add back. It's because our flow is from accrual basis to cash basis. What is the accrual? Net income. What's the cash basis? Our operating cash flow. So we move from accrual to operating. So to get our operating cash flow under cash basis, we need to remove whatever items that are non-cash. So if ever asset, for example, would decrease, this would mean that actually we have sold some items, correct? So there is a proceed or there are proceeds. Therefore, that would be an inflow. So that's the point of that. That's why to summarize, anything that would decrease our asset or net income or income, we are going to add back, and anything that would increase our net income would be treated as an outflow, like increase of the asset. That means that we have acquired more. If increase in any liability, this means that we have actually had more liabilities like borrowings of the money. Therefore, there are proceeds. But if there is a decrease in liability, that means we have paid. So that's an outflow. So hopefully you are going to take note of that. Net income, that's going to be an inflow, that's a plus. Net loss, a minus. While depreciation and other non-cash charges, these are non-cash expenses which are deducted already from our computation of accrual-based net income. Therefore, we add back. Dividends paid, clearly that's cash payment. While the sale of common or preferred stock, that sale, that's positive or plus, while repurchase or retirement of stock is a minus. Moving on or forward, this is a sample statement of cash flows of the entity. Again, we can see the three activities accordingly. And let's check. We will pause for 30 seconds, look into the operating activity section, and determine what method that we have made. I've already mentioned to you the two methods, direct or indirect. So analyze under 30 seconds and let's find out. Okay, so 30 seconds has lapsed. Of course, in your end, you are the ones pausing the video. So our answer here, this is indirect method. Why is that? We are starting from net income and moving forward to cash provided by operating activities. So this means accrual to cash basis. While investing activities and financial activities will focus and will only be having direct method, no indirect method for the two. Remember OIF, that's our acronym for the activities. Then another one would be our ratio analysis. So we have here our respective groupings. So the liquidity, activity, debt, and profitability. If we say liquidity, we are talking about the ability of the company to pay currently maturing obligations. So that's liquidity as opposed to solvency, which is for long term. Some books would have solvency ratios, but we will just respect with our source here. Activity ratios would be focused on how fast, the speed at which a firm converts various accounts into sales or cash. So example, how fast can we collect our receivables? How fast can we sell our inventories? How fast can we pay our purchases and the likes? Debt ratios would be with respect to our liabilities. Total assets financed by a firm's creditors. So liabilities focused. Profitability would be earnings in relation to other accounts on our financial statements. Profitability, profit or earnings. Then next, market ratios. In addition of the four, we have in relation to firm's market value to certain items or accounts. For our financial ratios, what's the point of them? For benchmark one, normally analysts would compare the current year's financial ratios with previous year's ratios. So just to check if ever there are trends that would help them evaluate the firm's prospects, or we look into the advantages of the firm and the opportunities of the firm. While benchmark two would be we compare the ratios of one company with other firms. So basically, this is a matter of being able to compare within the entity. So that's going to be intra comparability, or the second intercomparability. So intra within, inter in between organizations or entities in the same industry. Because remember, we cannot compare apples with oranges. If we compare apples to apples, then we are talking about belonging in the same industry. For liquidity ratios, which would focus again on how the entity or how fast the entity can pay its obligations, we have current ratio and quick ratio. Our current ratio, also known as banker's ratio, would be current assets over current liabilities. Well, that's the formula. And then for the industry, then we are going to base it on the requirement. Normally, if we can have like at least 100% for current assets over current liabilities, that is fine or healthy for the company. Next is quick ratio, also known as asset test ratio. We're looking into the quick assets. So out of all current assets, we have cash and cash equivalents, we have short-term investments, and trade and other receivables. These are quick assets. But inventories and prepaid expenses, these are actually not quick because inventories have to be sold, while prepaid expenses are to be expensed later on, then divided by current liabilities. Next, for the activity ratios, we have, depending on the books, there are so many, but here are the common ones. So inventory turnover, which would check as to actually the speed at which the company can basically sell the inventories. So we have cost of goods sold divided by our inventory. So normally, if we talk about income statement or statement of comprehensive income item, that's going to be 1 year or 1 term. But the balance sheet or statement of financial assets will be averaged if provided in the problem. So that's why we can have this like average inventory. For the average collection period, or ACP, also known as days sales outstanding or DSO, the formula would be accounts receivable. So whatever it would be the balance of accounts receivable average divided by average sales per day. Now, the average sales per day would depend upon the book. But here we are going to normally use 365 days. Anyway, the question would be telling us. I understand that some books will be using 360 days as business days. Well, again, it depends upon the agreement. But here we will use 365. For the payment period, this is the average also APP. That would be on accounts payable divided by average purchases per day. Again, divided by 365 days. Fixed asset turnover would be for sales divided by our net fixed assets, net of depreciation or valuation allowances. So if we can notice for turnovers, normally the above item would be the sales or the income portion, and then the lower part would be our respective assets or our turnover items. So that's why if we say inventory turnover, the denominator is inventory. Fixed asset turnover, the denominator is net or net fixed assets. But for inventory turnover, it's just that we partnered inventory with cost of goods sold because basically the inventories would be talking about cost. But if this is like receivables turnover, the formula would be our sales, basically net credit sales, because credit sales relate to receivables. Remember, we also have cash sales, and such would not be part of the receivables. Net, because it should be receivables net of the allowances, like the allowance for doubtful accounts, and divided by our asset. So receivables turnover denominator would be average receivables. So if we say average 2 years accounts, we add divide by 2. Then total asset turnover, so sales divided by total assets. See, sales above, denominator would be the item that is with a turnover. Then debt ratios, focused on our liabilities. Debt ratio is total liabilities over total assets. Assets to equity, it's there already in the name, A over A, so total assets over common stock equity. So only the equity belonging to our ordinary shareholders or common stockholders. We also have debt to equity, so long-term debt, and to be divided by the total stockholders' equity. Whereas the TI or times interest earned is earnings before interest and taxes, or EBIT. Basically, that's operating income. So sales minus cost of sales equals gross profit less our expenses with the exception of interest and taxes. So that's EBIT. And then divided by interest expense. We'd like to know, like, our EBIT can absorb the interest how many times. Next is profitability ratios. So we have the margin, gross profit over sales. And then for operating profit, we have operating profit over sales. So profitability, focus on the profit. Well, the net profit margin, well, this is now the margin or the ratio. We can say gross profit ratio, gross profit over sales. So the denominator would be the sales. The net profit margin would be earnings available for common stockholders. So whatever will be the net income, we deduct the preferred dividend share from there out of the income, so that we would be getting the earnings available for common stockholders. Then earnings per share will be same as net profit margin, but we divide with the number of shares of common stock outstanding. Common stock outstanding would be the issued shares of ordinary shares or common stocks less treasury shares, or the shares which are bought back by the corporation. Then we also have profitability. So return, we would be seeing a lot of return on something. Return on total assets, the denominator would be the return something, so total assets, but the numerator would be the earnings or return. So return on total assets, return numerator, which will be the income portion, and the denominator would be the total assets. It's like also the turnover a while ago under activity ratios, total asset turnover. So the denominator will be total assets. Then return on common equity. So the denominator will be common stock equity. All right, then profitability ratios. Let's say we'll be using DuPont system of analysis. If we say DuPont, we are going to make use of 2 ratios as a minimums. That's why DuPont, a dual point system. In this case, we have the net profit margin multiplied by the total asset turnover. Knowing the formulas of the two, substituting the formulas, we can eliminate sales, remember? And then earnings available for common stockholders divided by total assets, because sales will be eliminated, we can be getting the return on total assets, right? So by multiplying two formulas, we can also get other ratios. That's the point of DuPont system of analysis. And then we also have return on equity, in which we can make use of the return on total assets multiplied by A over E, also known as asset multiplier. So we have to substitute the two formulas and we can eliminate total assets, thereby getting the formula for return on equity. So earnings available for common stockholders divided by the common stock equity. Next, for market ratios, which would really be focused on the market prices of shares. So we have the first one, which is normally to be asked, P or E ratio. That's the market price per share of common stock over earnings per share. Why is it that we emphasize common stock? It is because for earnings per share, actually, we will be focused on what will be received by our outstanding and remaining shareholders, who are the ordinary shareholders or the common stockholders. As you can notice, I am using two terms, both for our UK GAAP or IFRSs and the US GAAP, so that it will be cleared out once and for all. For book value per share, we have the common stock equity, so whatever is going to remain, divided by the number of shares of common stock outstanding. In addition, for market or book or M or B ratio, that's per share again, but it would be the market value or market price over the book value, which was the second formula. Common stock equity divided by the number of shares of common stock outstanding. For the following slides, it will be for corporate taxes. Corporate taxes would be significant cash outflows, since they are normally percentages of our net income, or whatever has been left should we deduct interest from our earnings before interest taxes, or interest and taxes known as operating income or profit. So ordinary corporate income, we also have the same setup in Philippines. They're comparable. So progressive tax rate schedule, wherein we follow tables, and then the average tax rate would be tax divided by the pre-tax income, because the tax to be obtained is actually to be divided with the respective pre-tax income, and we are talking here about the tax rate. And to get our tax in peso or dollar, that would be pre-tax income times the rate. So let's say the income is 100,000 times the rate of 20%. Therefore, our income tax expense is 20,000 pesos. If we do the reverse, 20,000 over 100,000, which is being discussed here, that's the average tax rate of 20%. And we have to take note that in any analysis under financial management, it would be best to make use of the marginal tax rate, or what is going to be the remaining percentage. And then we also have the corporate capital gains. So under existing tax laws, ordinary income tax rates apply. In different tax jurisdictions, it would differ also in the Philippines. We will discuss that more in taxation subjects. Then these are the items that we've discussed so far for FS and CF analysis. The basic financial statements composed of balance sheet, income statement. Then we also have the notes to financial statements, the statement of changes in equity, and statement of cash flows, and our ratios: liquidity, activity, debt, profitability, and the market ratios. Thank you very much for listening. That's the end of our presentation. Hopefully you learned something from this session. God bless us all, and see you in the next video.